Play mode.
Testing. Testing. Yeah. Alright, good morning trading reps and clients. Welcome to Phillip Securities Research Weekly Market Outlook. I'm Wilmar. First I'll start off with the outlook for markets, followed by Brian, who will cover our featured company for this week, which is Hobie. So for markets last week, it was a rather quiet week in terms of macro data. But what we are seeing is that macro and markets are actually diverging. So if you look at this chart shows that in terms of your JP Morgan global economic activity, it is still expanding, but at a slower pace, right? Same for manufacturing as well as services throughout the whole world. But if you look at global markets based on your MSCI World, it continues to be on a rampage. Now, also last week, right, we're actually seeing more signs of a currency war, which actually began with Bank of Japan actually targeting to double the monetary base in 2 years, based on its announcement in early April last month. And last week we saw the ECB, the Bank of India, Royal Bank of Australia, as well as the Bank of Korea undertaking a 25 basis points cut. Even the Royal Bank of New Zealand actually intervened, which was a rare occasion. So in essence, we're actually seeing signs of a currency war gradually evolving into a trade war within the Asia Pacific as central banks undertake interest rate cuts as well as FX interventions and devaluations to actually get a competitive edge in the export space. Over the weekend, we have murmurs with regards to the Fed's planning of a strategy to exit from the large-scale asset purchases that are of the tune of around 85 billion per month, right? There are two questions that remain. The first of which is, when will the Fed exit? And second is, how would the Fed actually manage market expectations once it exits? So on this note, we could get clues, right? What to look out for. We could get clues of when and how to manage market expectations. We could get clues by looking out for this round of, because this week there'll be many Fed governors actually giving speeches. So we could get clues on that front, as well as Bernanke. Bernanke also will speak on May 18th, which is a Saturday, and we also can get clues on when will the Fed exit and how they will actually manage market expectations when they do so. In the US, we see the S&P 500 continuing to much higher, right? And it seems that although it clears the 1,600 psychological level, price action seems to suggest that the rally has sort of consolidated in the absence of a positive catalyst. So in the near term, it might pull back to its 10-day moving average, albeit in a still upward trend. Moving on to Japan, we see the USDJPY actually punching through the 100 psychological level. The key thing to note is that it's not the case that the yen is, or rather it's not the case that Japan is undertaking further aggressive monetary easing. But the thing is that in terms of US dollar, it has actually been strengthening against most currencies throughout the world, including the Aussie, Australia, right? So with that in mind, after clearing the psychological 100 level, the Nikkei continued to much higher, even after the opening bell of today, right? Notwithstanding Bank of Japan's aggressive monetary easing, we are cautiously optimistic on Japan on account of signs of structural micro reforms, as well as signs that the economy is actually regaining strength. Recall that in Japan, the Japanese PMI had actually hit a 13-month high recently. And the thing to look out for Japan is this week's earnings release, right? We should expect to see some upside from Japanese exporters in terms of their earnings on account of a significantly weaker yen. For the HSCI, we are actually seeing some incipient signs of a bullish upturn, and we are optimistic that it could actually challenge the 11,500 strong resistance level next. HSI, we alerted our clients as well as internally on signs of a bullish upturn 2 weeks ago, and in fact the HSI continues to much higher and is on track to challenge the 23,500 level and possibly even the 23,950 level previous high. For the STI, it continues to move higher, right? And after clearing the 3,400 level, the next possible level will actually be the 3,485 level, but we caution that it might not be a straight route up. In fact, there could be a possible pullback, right, on rumors or negative news, such as the Fed is exiting from a large-scale asset purchases. But as long as it remains above key support at 3,320, we think that it has room to challenge 3,485. For the Thai index, it broke through the 1,600 level last week, invalidated a bearish double top, and in fact, we are optimistic that the Thai index will continue to move further upwards, right, on strong earnings projection by Thai strategists. The Jakarta Composite Index, it hit the 5,000 level, it pulled back, and then after which we reckon that it's likely to challenge fresh highs. But we caution that for Jakarta Composite Index is trading around 19 times PE, which is based on its historical standards. Valuation seems a bit stretched. So thus in the near term there could be some possible pullback, which would offer clients and investors an opportunity to enter the Indonesian equities if they have not already done so. For the KLCI, we had a relief rally last Monday after the 13th general elections, but remember when on the same day we issued a note to say that we are actually market with Malaysia instead of overweight, and indeed it seems that this relief rally is dissipating. Now, I think why we actually market weight Malaysia is that if you recall, Najib, after doing so much by giving massive cash handouts, by pump priming the economy, and still perform worse than his predecessor Abdullah in the 2008 elections, this suggests that he's likely to face a leadership challenge towards the end of this year within UMNO, and investors and markets are wary that that could actually provide headwinds to programs such as the Economic Transformation Program, as well as the Government Transformation Program, which are actually key pillars of Malaysia's domestic demand story. Nonetheless, once the uncertainties on the policy front clears up, we will continue to update our clients on our views on Malaysia. With that, I'll pass on to Brian, who will cover Hobby.
Hi, good morning. This is Brian speaking. Today we are talking about Hobby. Just to recap what we had said in about 2 months ago, and also to give you an update on the latest Q1 results. Mainly Hobby, the business segment, mainly in the property development, where they build and sell their residential, and also property investment, where they are commercial office or industrial property that they're holding and collecting rental, and hotel division they have divested last year. These are some of the examples of the key projects that they undertaken previously. Just to highlight some of the current development that is remain unsold, mainly from Sentosa Cove. The first one, Turquoise, they have 90% stakes, and they still have about 48 units unsold. Second one is Seascape. They holding 50% stakes. It's a JV, and they still have 100 units unsold. And the last one is Pinnacle, which is they have not launched this project. So I would say that their inventory mainly concentrated at Sentosa Cove. And the thing is, they are renting out their completed projects and collecting rental. So the rental income, it's able to cover the finance and the maintenance expenses for these projects. And at the meantime, they are waiting for a good time to sell these remaining units. And if you may be concerned about the whether these projects are subject to the extension fee that other developers may get, which means they have to sell. The project completely within 2 years of completion, or else they have to pay a penalty. And for them, because this project they bought the land from government, so they are not subject to this restriction. So they can continue to hold this completed project at the moment. And for Q1, the revenue mainly came from property development, which the segment saw increase of 75% year-on-year to 58.1 million. And this mainly came from the recognition of projects and completed last year, which is the Tri-Light. So some of the remaining sales, they are recognizing it in this Q1 this year. And demand for Sentosa Cove condo continue to be slow. And they, as I said, they are waiting for good time to unload. And as we can see from this chart here, these are the transactions in Sentosa Cove. where we can notice that currently the sales momentum is still slow, still quite low. But we can note that over the past 2 years, it has been picking up gradually in FY11 and FY12. So they probably they can have the sales momentum can pick up in the next 1-2 years. And revenue, currently 2013 revenue is pretty low compared to historically. This mainly because the residential projects that they have already more or less completed. So this segment, the sales from residential sales, it's slowing down. So so this year they actually have no major completion for residential projects, except for one commercial project, the Metropolis. And currently their net gearing is quite low, below 20%. And which means they are able to seek more investment as well as overseas opportunities. And this is an overview of their overseas project. Currently they have 3 projects in China and 2 projects in Australia. And the work for the first 2 projects here, Shanghai Qingpu and Tangshan Nanhu, these 2 projects already started the development work. And according to the management, they are targeting to launch one of the projects in China by second half of this year. And the rest, the project in Australia, they have not started any of this development. And as I said earlier, the residential project, they have no more major residential project completion this year. What they are looking for is their commercial project, the Metropolis, which will be completed by end of this year. And this is a 1.08 million square feet Grade A office building located at One North. Currently, it's already 60% pre-committed to multinational companies like UOL and Shell. So with this completion by year end, we expect the Hobby to book a reval gain upon the completion, as their development cost is low relatively to the market valuation of this building now. And we did an estimate for reval gain last quarter, but now we actually increased the valuation slightly. So currently we are looking at surplus from reval gain of about 520 mil, which they likely to book this amount by end of this year. And as a comparison, our valuation is 1,355 PSF as compared to some other comparables. I would say it's still relatively around the same region. Like PSA building is 1,250, and NOL building is 1,830 PSF. But NOL building is a freehold development, and it has some asset enhancement potential. So on PSF basis, it's slightly higher. So this will be the highlight for this company at the moment. Is substantial reval gain, which will significantly lift the NAV of the share price of the shares. And in terms of earnings, FY13 property development, as I said, weakened, and but nonetheless, we expect FY13 to remain profitable for Hobby with PATMI of about 109 million. And this mainly supported by recognition of two divestment gains. One is from this selling this investment holding company, Chongbang Holdings, in the first quarter, which they did. The recognition is first quarter, and next quarter we expect them to book the divestment gain of Windsor Hotel, which they divested last year, and the completion is expected to be in second quarter. So with these two divestment, it will be the base for this year profit, which will make the company remain profitable for this year. And this is the reval gain that I mentioned earlier, which will further boost this year PATMI to 500 plus million. And the bulk, I would say the bulk of this part here is come from the reval gain by end of this year. And going forward, next year and the next 2 years, we could expect recurring income of 50 million yearly from Metropolis alone, which will enhance the earning qualities of the company. And currently, the valuation remain undemanding in our view. Net gearing is low, so there are headroom for potential acquisitions. And trading price around $2.15 as of last Friday, which is about 18% discount to their book value of $2.64. This book value is before their reval gain. So by year end, this book value will increase substantially due to the reval gain. And currently, it's 49% discount to our RNAV estimate of $4.20. So it's still a stock has an undemanding valuation now, in our view. And share buyback, they did share buyback in Q1, but so far after the first quarter result, they have not done any share buyback. But if this share buyback continues, that will serve as a support for the stock. And at the same time, currently the chairman is holding about 75% of the outstanding shares. So free float wise is decreasing, and I mean we do not speculate on any privatization of this company. But I mean, if the company want, the chairman intend to, I think it's not a difficult task. And looking at the free float is trending lower. And we have a buy recommendation with target price of $2.52. It's a 40% discount to RNAV. And it's about 26% discount to the forward book value of $3.42. So I think that's all for today's presentation, and we welcome all questions from the audience. Thank you.
Hi, with regards to your question on Wilmar itself, basically we think that there's still upside potential for Wilmar's share price to recover. Our target price for Wilmar is at 370. Wilmar's share price, if I'm not wrong, is currently trading at around 340. Why do we expect a recovery? There are a few factors. One is that the recovery of the crushing margins in China. It has posted 3 consecutive earnings, positive earnings, and we expect this margin to normalize going forward. Next is also the palm refinery margins, which again remain stable and robust, and we feel that it will continue to stay healthy going forward, at least for 2013. Sugar segment also posted a rather, better earnings result in first quarter this year. We see fewer losses in the first quarter, and this is very positive to us. It's a positive surprise, in fact. While plantation segment is affected by the CPO price, we think that the rest of the segment should be able to support Wilmar's earning going forward in 2013.
Hi, hello. Hi, okay, this is Brian here. I'll take the question on how is Wing Tai and OUE valuation compared to Hobie. Okay, OUE, we have an accumulated rating, and the valuation is also undemanding in our view, because their book value is also comparatively quite high, relative to the trading price. And the same as Hobie, OUE also has a catalyst, which is they are working on their hospitality REIT. They are working on to spin off their hotel into a hotel REIT. So if that deal is successful, I think that is a good channel for them to realize or monetize their asset value. Because currently the hotel assets is at a depreciated carrying value in their book. So if they can sell it, put it onto a REIT, it will be better off for them in terms of valuation, as well as it gets tax transparency from the hotel operations. And so we preferred Hobie and OUE over Wing Tai because these two, Hobie and OUE, they have catalysts on. Hobie is the reval gain by year end, and OUE is the listing of their REIT. As for Wing Tai, we don't see any obvious catalysts yet now, except that the market may be talking about privatization, but we think that is pretty unlikely because the owner, they had done an increase in their stakeholding in Wing Tai, I think some time ago. So if they want to privatize, they would have done it earlier on. So I think we preferred Hobie and OUE over Wing Tai for their more near-term catalysts, right? And there's another question on why is the cash flow for Hobie is negative for FY13, and that is quite simple, because for Hobie, the sales recognition, it would be lower for this year. They don't have major residential project recognition or completion, I would say. So this year mainly they will be in a outflow position, which mainly channel to their metropolis, the development costs. That's why they have negative cash operating cash flow. And that's still not a concern in our view, because as long as their project they have the proper financing done, and that will take the concern off. And another question on what about Keppel Land and Capital Land. We have accumulate rating on Keppel Land, while we have accumulate on Capital Land, while neutral on Keppel Land. In this case, for Keppel Land, we noticed that for Capital Land, we noticed that their sales increase or improve tremendously for the past about 3 quarters. So for Keppel Land, the improvement is not that obvious yet. And for Capital Land, they actually have more pipeline assets in their portfolio, which it's waiting to be mature in the next 2 to 3 years, as they have spent a lot in the past 2 years in acquisition. So now it's just focusing on execution and also get the development completed in the next few years. And that is, we think that there's more upside from all these development projects. And okay. I will take one more question on Hobie. It's on any insights into their strategy going forward. Hobie doesn't seem to be doing anything much in Singapore besides Metropolis and Sentosa. All right. Actually, currently the management they are focusing on a commercial front, and we did note that Hobie bid for some residential plot sometime a few months ago, but they are not very active in bidding for residential project. And over the past 2 years, they have been transferring their focus to overseas project. I think the management think that there are more opportunities in the overseas market. So at the meantime, meanwhile, I would say they are more focusing on commercial project in Singapore, whereas residential project it will be an overseas one. I will pass on to my colleague.
Hi, regards to Golden Agri. Currently the share price is still pretty weak due to the fact that the weak CPO price, because gold and agri is highly correlated to CPO price, and we are of the view that CPO price will remain muted in the near term. So gold and agri's share price may still be pretty weak going forward. Having said that, we are waiting for the results from gold and agri, first Q result today in the evening. So we will give you more updates after the briefing today. Regards to ISRA, we think that the subsea market is still pretty bright going forward. ISRA had won a subsea contract early this month, which is worth $75 million from Stake Oil, and this continues to show that the fact that the subsea market remains strong going forward. But then again, concern still remains going forward for the subsea market segment because of the ramping up of their operations after the merger of the AMC. Thank you.
Hi, Joshua here. Okay, there's a question on the Malaysian elections and the impact on Rowsley. Well, basically, because the DAP candidate has defeated the BN candidate in Johor, so the question is wondering what's the impact on Rowsley, because BN has been the party that has been driving the Iskandar project. Well, actually, our view is that there's not going to be much change for Rowsley. There's not going to be any impact for Rowsley because, first of all, it's a project that is with the Sultan of Johor, and the plans for the Iskandar region are not going to be derailed by this change of local government, state government in Johor.
Okay, with regards to Keppel Corp, our price target for Keppel Corp remains at 12.34. The recent weakness in terms of the share price is mainly due to the corporate action recently, which resulted in the drop in their share price. That's after their ex-dividend price. But then again, the O&M outlook for Keppel remains strong. Orders are coming in, and in fact, management are still seeing strong inquiries within the ultra deep water segment for their rigs. And then again, for Keppel, we still see potential upside margins in terms of their O&M segment. Market is actually expecting O&M margin of around 14%, but we expect O&M margin to be even higher, and that will actually drive prices in our view.
I think we have no more questions from the audience. So we thank you very much for joining us today, and we'll see you again next week. Thanks very much.